Hello, welcome back to Weekly Market Recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So the past week, the S&P 500 was up 2.59%. We're still down year to date, 16.88%. In the NASDAQ, we were up 3.32%, but we're still down 24.37%. So we have seen a little bit of a rally this week, but overall still heavily forward for the year. Now, the big catalysts this week are earnings continue to come in and in general positive. And so we've seen some positive moves in the market and just the continued digesting of no Federal Reserve talk for the past 2 weeks. So it's been relatively calm on that front, but also still digesting some of the strong jobs data that we got, as well as high inflation, but also pairing with some pretty large decreases in commodity prices over the past few weeks. So let's jump into what we see in the market. So in the market overall, on Monday, we actually did see a little bit of a fall, fell into the close, and then from there on, pretty strong the rest of the week. Mostly as earnings came in positive. Tesla beat, which was a shock to the market, especially with some of the slowdowns in China. And then really through the end of Thursday, we were pretty strong. Then on Friday, we did see a pullback. We saw a pretty big miss by Snapchat Thursday after hours, and it kind of spooked the market on advertising. We did see a sell-off and then a little bit of recovery into the close. But the reason why the Snapchat miss was so shocking is it's really around advertising. And the initial story that some people had on the advertising front was that we had this inventory issue, supply chain issues, and then the hope was, okay, we're seeing supply chain issues right now, prices are going up dramatically, but hopefully inventories are going to start to build up. And then as inventories build up, people are going to decrease prices, but also a way of seeing that sort of trend is when inventories are built up, people or companies start to advertise more, and they advertise more so that way they can start to sell that inventory. However, this is if the expectation is that the market's going to be okay and people are going to continue to buy goods. Now, the story changes if people are afraid that we're going into a recession. Now, it's the complete opposite story. Whereas companies were willing to invest in advertising to sell more goods, then that's if they expect, again, to avoid recession. However, if companies are now starting to expect that we might go into a recession, even though they might have higher inventories, the last thing they want to do is spend on advertising and then not actually have people buy those goods. So if we're in category number 2, Snapchat missing because they're really struggling to sell advertisements, which are for 2 reasons. But the negative reason that I think the market is seeing is, okay, well, if companies aren't willing to buy advertising, it's probably a big reason because they're afraid of the recession.
And what we're looking at is not only does it create a problem for Snapchat, which is a small company, but you have to look at, are we going to see the same thing from Google? Are we going to see the same thing from Facebook? Are we going to see the same thing from Amazon? And pretty soon, if that's the case, they're going to be cutting back on a lot of their investments, paring back, preparing for recession. And all of those pieces are starting to, I don't want to say spook the market, but did give pause to the current rally on this week.
As we talked about in our investment commentary letter, where the market is right now is between 2 areas. We could either fall into a recession and then we probably have a couple more lows to hit, or we could avoid a recession. And if we avoid a recession, we probably hit the market low already. Data is saying 2 different things. Right now, we still have an inverted 210 yield curve, which means that in the bond market, there's still the expectation that we are probably going to go into a recession within the next, 6 to 18 months. However, we also just had the jobs data from June, and that was still really, really strong, which shows, well, why are we adding so many jobs if we are, on the brink of a recession? Now, we do see some slowdown in some companies saying that they're not going to hire as much, but we're still seeing a lot of job ads. And with the thought of, well, inflation could still come down. Now, how much of that is just wishful thinking versus actual reality, we might see. But there are some thoughts that, okay, the Fed can still execute a soft landing. And one of the thoughts was, after the really bad CPI read of over 9%, the thought was, okay, the Fed's going to have to raise interest rates by 100 basis points or a full 1% and really shock the market. But since then, with the really good jobs data, with different commodity prices coming down, with earnings season and GDP results that will be coming out soon for the second quarter, the thought process is maybe the Fed doesn't have to hike rates as much. And I think the market has seen a little bit of a rally because of that.
And we've seen some expectations related to inflation, which is something that the Federal Reserve watches very closely, pared down, and does not seem as bad as it was more recently.
Yeah, what Rich is referring to, and we've talked about a lot, are the two measures of inflation: the 5-year break even, which is the TIPS, which is the Treasury inflation protected security, compared to the regular 5-year Treasury. And that has right now been around 2.5%, which is a lot lower than where we saw that peak at around 3.5. And so we've seen that come down significantly, which is really exciting to see. And the other item that we measure for inflation is, what does the consumer expect? And that's usually measured through the Michigan survey. And that was, again, not this past Friday, but the Friday before. That number came out. Instead of it going up, which was the fear, it actually came down a little bit, which again was a miss to the downside, but positive for the market and potentially how the Fed will react. So both of those items are in the positive for how the Fed might act in the coming weeks. Now, the biggest catalyst on the horizon is the GDP reading that we're going to get for Q2, which will come out next week. And this will basically be able to tell us, are we in a recession right now? Depending on which Fed bank you're looking at. So the Atlanta Fed says that we are already in a recession, or the expectation is that GDP for second quarter was negative. But if you look at the St. Louis Fed, it's actually positive GDP for the second quarter. So again, even the skilled economists at the Fed, you go to two different banks, two different branches, and they're saying different things. So we don't really know how that's going to come out. But again, next week, we're going to find out whether or not we're in a recession from 2 negative quarters of GDP decline. Now, technically, to be labeled a recession, you need that, and then the economic advisors, Bureau of Economic Advisors, to actually come out months later and say, yes, we view this as a recession. But for the most part, next week we'll be able to say whether or not we believe that we are currently in a recession and either on our way out, or if we're not in a recession because we had 1 quarter of negative and then the next quarter actually positive GDP growth. All right, well, as always, we appreciate you guys tuning in. Remember, we're here to support you. Your mind's here to support you. And we'll see you again next week.